Hey there, Money Loop family. Don't forget to subscribe for smarter financial success. Let's dive into today's money strategy. This is what a market grappling with a sudden shock of uncertainty looks like. A bombshell story just dropped, and it's sending major ripples across the board. We're going live because what's happening right now is going to have a domino effect on every single sector before the market closes today. We just got the June inflation numbers, the Consumer Price Index, and this report has thrown a massive curveball into the market's game plan. Headline inflation just clocked in at 2.7% over the last year. That's a jump from the 2.4% we saw in May and the highest we've seen since February. Now, some people saw an increase coming, but this number confirms that the fight against inflation isn't over. This has completely changed the conversation around the Federal Reserve's next move. In the next few minutes, we're going to break down what this news actually means, why it's a game changer for Wall Street's expectations, and what you need to watch in key sectors like tech, financials, and energy. We'll also look at the bond market and the US dollar to get the complete story. So stick with me, because making sense of these cross-currents is absolutely critical. Alright, let's rip this report apart and see what's really going on. The headline number, the one everyone watches, hit 2.7% for the 12 months ending in June. And just from May to June, prices popped 0.3%, which is the biggest monthly leap in 5 months. This matters because it breaks the cooling trend we were getting used to earlier in the year. So, where's this heat coming from? When you dig into the numbers, a few things stand out. Energy costs, which had been giving us a break, reversed course and jumped 0.9% in June alone. Food prices are still climbing and are now up 3% over the last year. We're also seeing the first real effects of new tariffs showing up in the prices for things like home furnishings, recreational goods, and apparel. But here's the twist, and this is where things get really interesting. The core CPI, which takes out the jumpy food and energy prices, actually came in a little cooler than some economists expected. Core inflation was up 0.2% for the month and 2.9% for the year. That was just a hair below the 3% forecast some analysts were worried about. So you've got two different stories in one report. The inflation that you and I feel every day on things like gas and groceries is ticking up. But the underlying trend is a bit more under control, even though it's still way above the Fed's 2% target. Why is this such a big deal right now? Because it puts the Federal Reserve in a very tough spot. The market has been betting for months that the Fed was getting ready to cut interest rates to give the economy a boost. Fed officials even projected 2 rate cuts for later this year. This inflation data throws a wrench in those plans. It makes a rate cut at the upcoming July meeting highly unlikely. The odds of the Fed just holding steady when they meet on July 29-30 are now through the roof. This doesn't mean they're going to start hiking rates again, but it definitely means their wait-and-see approach will continue. This sudden rethink of where interest rates are headed is exactly why we're seeing all this volatility today. It's forcing a complete repricing of risk. Now, let's track how this news is hitting different stocks. When the rules for interest rates change, the money starts moving, and fast. First up, the most sensitive group, tech and high-growth stocks. These companies are valued on big promises of future profits. When interest rates are expected to stay higher for longer, the math used to value those future profits changes, making them worth less today. That puts immediate pressure on their stock prices. We're seeing a definite pullback here as investors realize that cheaper money isn't coming as soon as they'd hoped. It's a classic risk-off move. The market sheds its most speculative names first. Next, financials. This one's a bit more complicated. On one hand, banks can make more money in a high-rate environment. The gap between what they pay you for your savings and what they charge for loans can get wider. But there's another side to that coin. The big fear is that sticky inflation and a higher for longer Fed could choke off the economy. A weaker economy means fewer people taking out loans and a higher risk of defaults. So for banks, it's a real tug-of-war between better margins and a shakier economic future. Now, let's talk energy. This sector is having a fascinating day. As we saw in the report, higher energy prices helped drive that hot inflation number, jumping 0.9% for the month. This is a double-edged sword. Higher oil and gas prices are great for the bottom line of energy producers, and these stocks are often seen as a good way to hedge against inflation. But these companies also depend on a strong global economy. If the Fed has to stay tough on inflation, it could slow down the economy and crush future demand for energy. So we're seeing some strength, but it's being held in check by those bigger worries. Finally, what about the so-called defensive sectors, like consumer staples and utilities? These are the companies selling things we need no matter what. Think toothpaste and electricity. In theory, they should be a safe place to hide. And we are seeing some investors moving into these names today. But even these companies aren't completely safe. They're also dealing with higher costs from inflation and have to decide if they can pass them on to customers who are already feeling squeezed. This is the complex chain reaction we're seeing play out in real time. It's not a simple, everything goes down, event. It's a smart rotation as the market digests a fundamental change in the landscape. Look, if you're finding this real-time breakdown valuable and want to stay ahead of these crazy market swings, do me a favor and hit that subscribe button and turn on your notifications. The market never stops, and I'm committed to bringing you the clear, no-hype analysis you need to navigate it. When you subscribe, you're joining a community of smart investors who are staying ahead of the curve. It's not just about stocks. This inflation news is also causing major waves in two other places you have to be watching: the bond market and the US dollar. You can't get the full picture without them. Let's start with bonds, specifically the 10-year Treasury yield. Think of it as the base interest rate for almost everything in the economy, from mortgages to corporate loans. After the CPI report, we saw the 10-year yield tick higher, hovering around the 4.4% level. That may not sound like a huge jump, but it shows the bond market is instantly recalculating the odds. Traders are now pricing in a lower chance of Fed rate cuts anytime soon, which pushes yields up. That means the cost of borrowing money is getting more expensive as we speak. The relationship between different bond yields is also telling. We're keeping a close eye on the spread between the 10-year and 2-year yields. That part of the yield curve has been inverted for a while, which is historically a pretty good, though not perfect, warning sign of a recession. Today's news just adds another layer of complexity to that signal. Now, for the US dollar. The dollar index, or DXY, which pits the dollar against other world currencies, has gotten stronger on this news. This is a classic reaction. When the outlook for US interest rates looks better than in other countries, meaning our rates might stay higher for longer, it pulls in international money looking for a better return. That demand pushes the dollar's value up. It's also partly a flight to safety, where investors buy dollars as a safe haven asset during uncertain times. A stronger dollar isn't all good news, though. It makes US products more expensive overseas and can hurt the profits of big multinational companies. So, what's next? What should we be watching? The entire conversation has changed. The market is now completely data dependent. Every single inflation report and jobs number from now until the next Fed meeting will be put under a microscope. A rate cut in July? Forget about it. The new debate is whether the Fed can cut at all this year, like they once planned. If inflation stays hot, those rate cut hopes could get pushed even further into the future. Technically speaking, we're watching to see if major indexes like the S&P 500 can hold key support levels. Whether the market can stay above those lines in the next few days will be a huge test of investor confidence. A break below could signal a much deeper drop, but a strong defense might mean this is just a temporary dip. The biggest takeaway is this: the game has changed from guessing when the Fed will cut to asking if they can cut it all this year. That uncertainty is the new reality. To put it all together, today's inflation report was a splash of cold water on the market's rate cut party. The headline CPI number came in hotter than last month at 2.7%, pushed up by energy and stubborn food prices. This ties the Federal Reserve's hands, making it more likely they'll stay on the sidelines and stick to their cautious, data-driven approach. We're seeing that news cascade through the market in a classic rotation. Tech stocks are under pressure, the outlook for banks is murky, and some investors are moving into defensive names. Meanwhile, the climb in Treasury yields and the stronger US dollar confirm this new reality. The most important thing you can do right now is not to panic. Don't make a knee-jerk reaction. This is a moment for a deep breath, clear analysis, and patience. The market is processing new information, and that always creates some chop. The real economic fundamentals are what will matter in the long run. We will be watching this story develop all day and through the rest of the week. It is far from over. Thanks for joining this live market alert. If you found this analysis helpful, make sure you're subscribed with notifications on. You won't want to miss the next update. Thanks for watching MoneyLoom. If you found this helpful, like the video, leave a comment, and subscribe for weekly AI-powered money tips. Thumbs up, like, speech balloon comments, bell subscriptions.